Hi, hello and welcome. Been a little while since I've uploaded a video, a few weeks, 2 to 3 weeks possibly. I haven't gone anywhere. What has happened is there is now a new baby inside this house, so taking a bit of time away. Because of that as well, because of the news of the new baby inside this house, the way I do my videos is probably going to have to change for a little bit, because I don't have the time to sit down and do 2 hour long videos uninterrupted. It's not possible to have it uninterrupted with a newborn baby in the house. So what I think I'm going to do is do my research away from the screen, and then I will probably break down a thesis or something on a company in a short form video, which I know somebody in the comments previously has stated that I need to go more short form. So for now, that's probably the way that it's going to go. And to start with, we are going to start off with WPP, which is a worldwide British advertising agency. And as you can see by the share price, in the last, less than a year, we've dropped 60%. Post-COVID, we have dropped 70%. So, you know, this company is not doing very well. This came up on my screener. This is how I came across it. Price to free cash flow 0 to 8, and performance of a year below 40%. Very clearly, it has met the performance criteria. Now the question was, had it met the price to free cash flow criteria? And we're going to look into that now. I've already wrote a write-up on this, so I keep this for myself so I can go back in and look at it in the future should I come across this again. So people who don't know, WPP is a marketing and advertising company, the biggest in the world. They help big brands like Coca-Cola, Unilever, Ford, Google promote their products and build their image. They're a parent company, effectively, of loads of different advertising agencies. Those agencies create ads on TV, online, print, social media, where they're going to place them, to what audience. They manage the brand's public image and reputation, collect and analyze data to understand what consumers want, help brands sell online and improve their digital presence. So that is what WPP do. I have dragged it into here. What we would do is we will go down through my synopsis, because I said I'm trying to short form this because that's the only time I'm going to have. And we will go from there. So WPP's revenues, 38% is in America, 15% is in the UK, 20% is in Western Europe, and 27% is in the rest of the world. Now, most of their revenues are supposedly project-based and not long-term contractual. One thing that I have missed here quickly is that, and I don't like this is something I really don't like, Yahoo Finance, because I couldn't find in their own documents. I'm using Yahoo Finance, what they say for this, but I'm sure it's in there. I've just not spent enough time to look for it. So supposedly insiders only own 0.22% of this stock. So to me, capital letters, there's no inside conviction in this company. Not cool. I don't like that, to be honest. And we can see from going, oh sorry, I don't doing that. Here we go, it's here. We can see from the share price, there's not a lot of conviction from anybody. Not just insiders, but other market participants, other hedge funds and all that. Nobody's got any wisdom. WPP, BlackRock portfolios got 2.8% of their portfolio in it. The next highest one is Hotchkiss and Wiley, of only 1.15% of their portfolio. So nobody, everything else looked below single digits. Nobody's got any confidence in this company. That's what that tells me anyway. Nobody, unless somebody's bought it with a high degree of confidence, a large portion of their portfolio. You know, I want to see other people have conviction in stuff as well. You know, shameless cloner, as Monish Babai said. You know, 9.94% outside of BlackRock, which owns 5% of it. So there's no conviction in this from the insiders of the company or from the institution or investors at all. So as I said, no market confidence, no inside conviction. So the revenues, well, let's get it up on here. High, they are high, right? About 14 billion. The market cap is, at the time of making this video, it's possibly changed. Was around 3.8 billion. So for free, from a market cap perspective, because I use enterprise value, I think you should, because data is very real. But for 3.8 billion, you could buy 14 billion in revenues. Now, these 14 billion in revenues are declining, which is a problem for this company. And one of the reasons why the conviction for everybody has dropped. The actual enterprise value is 9 billion, so there's a significant amount of debt inside this company. So yeah, so that's the revenues. Gross margin, this is 3-year average here, okay? So 3-year average, the company has been declining. You know, since 2020, the company has been declining. They've managed to control costs, sort of. You know, SG&A's gone from 17% down to just below 10. But you've had a decrease in operating margin, a decrease in CFO, cash flow from operations margin, and a decrease in net income margin. So it's no wonder that this company has gone the way that it has. You know, the share price wise. We've also had a decrease in simple free cash flow margin. So it's not great, you know. Things are not looking great. There is also significant risks in this industry. So AI has become a significant risk to this industry. Publicis is a peer. So I've chosen IPC, Publicis. Well, I can't remember what IPC was now. There we go, Interpublic Group. So IPC is Interpublic Group. Publicis Group is the EU BGY, and OMC is Omnicore or something like that, Omnicom, I believe. So that's the ones that ChatGPT is at least stated as the biggest floated peer comparisons. So that's where that's come from. So AI it's become quite a risk to this industry, but it's also helping streamline this industry. So Publicis, one of their biggest rivals, invested heavily in AI and have seen their revenues grow whilst their organic revenues grow, I believe that is, whilst WPP's organic revenues have been contracted, and they've also lost large contracts recently to Publicis. They lost Coca-Cola's North American business to Publicis, which is obviously a huge thing to lose. So that would not be taken very well by the market. So there's been slowdown in economies, meaning that companies use less money on ad spending, which obviously hits an advertising company like WPP. They become more price sensitive and they look for cheaper options, which is what has happened. Obviously, you've had rising costs as well, inflation and all that that's started to put pressure on the margins, which we've seen the margins are decreasing. So what is being done to combat this decline? Well, WPP has cut 4,000 jobs from their media unit. They're streamlining their functions and they're merging agency brands. They've made a big investment in AI to bring them more in line with Publicis and their peers. They've done a 400 million deal with Google to embed Google AI into their service. They've also had a leadership change. I believe that's happening at the end of this year. So obviously that can bring uncertainty. When you've got your peers that have got your competition that has had steady leadership and things are going well, obviously that seems like a safer bet than changing leadership when things aren't going very well. So they've targeted savings of 125 million annualized, supposedly. So a lot of this I've got from ChatGPT because it's just faster to try and try and find data that way. Whether or not it's accurate is up for debate sometimes. Sometimes it is, sometimes it isn't. But in the main, it's reasonably well on. So that's what we've been looking at. So they're trying to catch up with AI, their AI stuff. I believe Publicis started investing in AI 3 years ago. So they were WPP were 3 years behind the curve. AI is expensive and restructuring takes time. After losing big clients, retaining or winning more is hard, and economic slowdowns were still hindering natural growth despite them wanting to build natural growth. So this is where WPP finds himself currently. So moving on to the balance sheet, I try to do this in a order where I understand the business and what it does. Then I'll go to the balance sheet because I think the balance sheet is the most important thing. Then I'll go to the income statement. Then I'll go to the cash flow statement. So this is how I've tried to set this out. So the balance sheet, it's over 6 billion in total debt, which we go to. There we go, 6.7 billion in total debt. I believe this includes the lease expenses as well, in the way that my data, which is Y sheets, collates it all together. So I believe total debt is including lease expense as well. But yeah, 6.7 billion in total debt, and there's an annual interest expense of around 385 million. We bring this up here. Down here, TTM interest expense 385 million. It's dropped slightly from 2023 when it was at its highest, but it's around about, the average is 346 over the last, what does that go back to, 2019. So it's not way above where it has been, and it has come down, but that is what you're dealing with on the interest expense for WPP. So current interest coverage ratio. So I use simple free cash flow for interest coverage. So its current interest coverage ratio is 1.67. It has been significantly higher in the past. This is the lowest it's actually been since 2020. But you still earn enough simple free cash flow to cover the interest, and that's the main thing. Simple free cash flow, I've got it calculated as 642 million, which is obviously significant declines year over year, which is not good. Again, another reason why the stock is under pressure. So I've got over 1 billion in debt maturing here, but actually it's over 2 billion in debt matures within the next 3 years. So we go to the borrowers. So this is the 20F. It's not the latest one, but this is the only one that I could easily find what bonds and all that, and what debt was actually out there in the financial statements. So click down on borrowings, which was here, and what I actually did was I just copied and pasted all this and I dumped it into ChatGPT and made ChatGPT break it down for me. They've also, on top of all these borrowings, got a rolling credit facility of 2.5 billion, but as of 31st December 2024, the revolving credit facility remained undrawn, says down here. Look, so 2.5 billion, which I believe they can take the maturity up to 2030. There you go. 2.5 billion, but none of it is currently being used. So they've got the option to use it, haven't used it. Dump this into, let's drag it down here. Where are we? Come on. It's this button here that does it for me. I dump this into ChatGPT, the whole thing, and then ask it to tell me how much is due when. So it's broken it all down for me. So for 2030, here we go, next 3 years, there's 2 billion euros worth due within the next 3 years. Now, are they making enough simple free cash flow to cover that before that all matures? Currently, no. So another reason why the stock is going to be under pressure. Now, we'll get onto it in a minute, but when I do my future, estimates and all that, I don't use, I think it's ridiculous to use what is current. So my future estimates are actually less than this. So I don't believe, bar some miraculous turnaround, that they're actually going to be able to cover their maturing debt, the 2 billion by 2030, just from simple free cash. Obviously, they've got the rolling credit facility to cover it. So problem with that is that also matures in 2030. So then they've got to cover that as well at the same time. So there is pressure on WPP with their debt maturities. I believe they're earning enough. My opinion, right? My opinion, don't take it with a pinch of salt, but my opinion is that they're definitely earning enough to pay off some of it, and probably going to refinance another portion of it. I don't think they're going to have a problem doing that, but obviously that pressure is there. So I did originally think it was 1 billion until I broke it down there. So this bit, ignore this bit because it's actually wrong, because they're not going to make enough money off of current simple free cash flow to cover it. So another part of the balance sheet I don't like, 7 billion of the balance sheet is in goodwill. So if we go to total assets or total non-current assets, 8 billion. 8 billion of the 11.5 billion is in non-tangible stuff, and 7 billion of it is in goodwill. Not a fan of that. I don't really like goodwill. I just think it's a future write-down. Current assets are actually quite good, though. They're mainly cash and receivables, as you can see here. So, the current assets aren't bad at all. Certainly, they are less than current liabilities, but obviously they've got a rolling credit facility, revolver, cover that. So, long-term assets, they're not high quality. Goodwill and tangible assets are 8 billion of 11.5 billion long-term assets. Tangible book value is negative. I don't generally like that, because I suppose you can use tangible book value as some form of proxy of liquidation value. It isn't, but you've got large cash holdings, which is just below the average 5 years of 1.7 billion. The 2 billion revolver, which we've already said, which expires in 2030, currently undrawn. Their return on capitals, though, they're not bad. We'll go to the comps in a bit and see what they're like. But so EBIT's return on capital, it's pretty good. Historically, it's pretty good as well. Simple free cash flow has dropped, though. If you're using, so EBIT's obviously unlevered. If you're using the levered earnings, so simple free cash flow, it's dropped, but it's still not bad, close to 20% return on capital. So, it's not the end of the world. So I've just wrote in all the balance sheet is not great, but it also doesn't need to be a problem if the business can stabilize. So down on the income statement on the revenues are declining, expected to continue for the rest of this year. And they were hoping for growth to return in 2026. So when you actually go to, so obviously, despite this growth margin has increased, has it? As I say, I didn't say that just now, did I? So it hasn't increased. No, it hasn't. Why did I say that? It's been looking at a different one. So gross margin down. I said, so we're on to the income statement. I've wrote it goes up, but it hasn't. So we're already finding faults in it. I've already said, haven't I? All the other margins have decreased. Operating margins slowly decreased as a net income. Simple free cash flow margin remains reasonable, and I believe that it is reasonable when you look at it historically. It's not as high as what it was in 2023, but it is up. The 3-year average is up on what it was the last couple years. What else have I got in here? So if we were to say how long would the company be able to buy itself back with EBIT, it would take 3 years. So the multiple, shut this down. Here we go. So by market cap, not the equity value, not the actual business value, the enterprise value. It would take 3 years, and if you were to use simple free cash flow to buy the market cap, it would take 6 years. So from that point of view, it's not enterprise value is what it is, because you're buying the debt as well, and there's a significant amount of debt, and then all of a sudden that rockets the outcomes of those. Open up the wrong bloody one there. I've got too many pages open here. So yeah, things aren't looking great. Obviously the revenues are slowly declining, losing big key, but Coca-Cola North America is a huge one to lose. That's gonna rock a company, really, something like that. On the cash flow statement, so operating cash flow is down, free cash flow has taken a 200 million hit, which we can see down here, 200 million hit, and it's taken almost a 400 million hit from what it was in 2023. Despite that though, EBIT has stayed reasonably stable. So the working capital's got worse, and I'll show you that here, because I got a working capital analysis page on my spreadsheet, where they're not collecting anywhere near as fast. They're collecting money 70 days slower. Their day sales payable, so how fast they're paying off their debts, it's higher than what it has been historically, but it's not. It's faster than what it was last year, so they're bringing it back down. It's not great, right? When that goes up, it's sort of manipulating. It's not sort of, it is manipulating the cash flows. So not great, but it's not too far out of line to where it's been historically. Bit of a, what would you call it, like an orange flag, I guess, that it's gone up over the years. It doesn't seem, it's not like all of a sudden you've added 100 days onto your payables, so slower to collect receivable by 70 days, significant decline. Payables have got slightly better, but still 20 days higher than the 7-year average. So the collecting significantly slower is a potential alarm bell. ChatGPT states that free cash flow is only 600 million TTM, largely because of working capital drag. Receivables are the main culprit, so they're not collecting the money that they should be, as fast as they should be. Let's put it that way. So simple free cash flow yield is 7%, which is obviously higher than the 10-year US Treasury, and that is against EV, and it's significantly higher when it's against market cap, and that is shown here. Simple free cash flow against EV, 7% yield. EBIT against EV, 14% yield. If you do it against market cap, it's way higher. Now, I don't do things against market cap, I do it against enterprise value, but investing in this as a business, from the standpoint of you're buying the business, you would still get a better return than you would putting it into US Treasuries. So, that's something. Obviously, if you're not buying the whole business, then you can lose money because the stock price is under significant pressure and still can continue to go down. That's not a recommendation at all. It's just a statement of what it would be like were you to purchase the entire business. Keep pressing the wrong one. Like I said, too many pages open. Let's shut that one, get rid of that one so I can't do that again. So, peer performance. IPG Publicis, it said Dentsu there. I didn't use Dentsu, I used Omnicom. Let's change that. Also, so all these companies are feeling the same pressures, same macro pressures due to lower ad spending, rising costs causing margin pressures. Peers with better AI are doing better, such as Publicis. All of them appear to be attempting to cut costs. Publicis is still generating organic growth. Others have negative growth around 2 to 3%, but WPP is the worst with negative growth of 3 to 5%. So this table here comes from ChatGPT. I just skipped a bit then, didn't I? Peers have mostly maintained or increased dividends. WPP has cut its interim dividend by 50%. Capital letters, this is a sign of weakness, and they have. So their dividend payment coming up. WPP, yeah. So 0.43 this time last year, 0.973. So they've basically cut it in half. Now, that is something that they've announced they were going to do. This to try and balance things, I believe, but the market doesn't like that. That seems a sign of weakness. If you need to cut your dividend, now I am a fan of companies cutting their dividends. A lot of people don't like it, but if shit is not going well, cutting a dividend is not the end of the world. It's a smart thing to do for the sake of the business. It's not a very smart thing to do for market perception. But yes, they've cut their dividend by around 50%. So it says here as well, WPP was late to the party with AI. Peers started investing 2 to 3 years ago. Now I said that is poor management, which is possibly why the CEO is being replaced at the end of the year. But if your peers invested in something 3 years ago and you are that late to the party, that is not good management. That is my opinion on it. So yeah, as I said, the peers have mostly maintained or increased dividends. WPP has had to so again, capital letters, sign of weakness, poor management, capital letters for not investing in AI. So what I've done here is this, look, drag this up here, front cover. I never, this is a bit of a fuck up on my part, I have to say. So my spreadsheet is set out for either, I've got a quarterly spreadsheet or something that is semi-annual spreadsheet. Now WPP is a British company, semi-annual reports. PUBGY, I think is French. Is it French? I'm not sure. Anyway, semi-annual reports. Now the other two, IPG and OMC, American. So they're quarterly reports. Now I couldn't put all of those into my spreadsheet, so I've had to go across 2 different spreadsheets. My US spreadsheet uses quarterly data, and my UK spreadsheet, which uses half data, to do the comparisons here. So WPP is trading by far the cheapest on EV to sales. I said 14 billion in revenues for on a market on EV of 9 billion. So, you know, by far the cheapest. Now, was it Shaughnessy did that book, What Works on Wall Street? I think price to sales was one of the biggest returns over time, investing in low price to sales things. So there's something in that. It appears lowest on the market cap multiple, simple free cash flow multiple against market cap. Now, when it goes to enterprise value, it actually becomes one of the more expensive ones. They're not earning enough simple free cash flow to compare to the enterprise value of the business. EBIT multiples, you know, they seem cheaper on that multiple. But look at Publicis' gross margin, 38%, and look at WPP's 16.6%. It is the lowest of the lot. Publicis is by far the better business when it comes to gross margin. Operating margin is the worst of the lot by a mile. Net income margin, worst of the lot by a mile. Operating cash flow margin, still the worst of the lot, but not necessarily by a mile compared to Publicis. It's definitely the worst of the lot by a mile. Simple free cash flow margin, worst of the lot by a mile. So when you're comparing this to its peers, it ain't great, is it? Return on capital, 29%, just over 30% for Publicis, 50% supposedly for IPG. I'm not sure this is correct for Omnicore, but I did look into this actually. It was 102%, so I believe that is around about correct on EBIT. Interest coverage, by far the worst. So yeah, when you're looking at it against its peers, it's not great. 68% of its capital structure is debt, so it's worse than all the others as well, debt to capitalization ratio. So compared to its peers, WPP, easily the worst company, despite apparently being the biggest advertiser in the world. It is, compared to the peers, currently the worst one out of the lot, which is obviously why the stock price has done this. Right, so moving on to my forecasting, they're supposedly expecting revenues to decline by potentially around about 6% over the next 12 months. And then they did say they're expecting them to rebound in 2026. So I've used actually a slightly larger decline from 14 billion down to 11.5. I try to be conservative as possible with everything that I do. And one thing I don't really understand as well, right? They're expecting margin pressures, but according to this, operating cash flow before working capital, they expect it to be 1.1 to 1.2 billion, which is more than wait, there we go, more than what it is TTM currently. So less revenues, margin pressures, but more operating cash flow. There we have it. So I'm not going to take all of that. I don't normally take all of that. Where are we? There, tracker. So what I've done is I have only used 70% of the margins when I'm using my free cash flow, and obviously I've used 11.5 billion instead of 14, even though they're using a 6% decline. The reason why I do this is that if I'm conservative with my valuation and it still looks cheap, then I see that as a positive thing. So on my valuations, I've got several different ones down here. This one here is literally just a net present value of future simple free cash flows. This is a Monish Babrai one from his Dano Investor. Net present value, future simple free cash flows, and then selling the business in either year 5 or year 10 and adding those simple free cash flows to it. And this one here is a Joel Greenblatt multiple analysis type thing. So that uses the 11.5 billion, which I've already put in up here. And then it uses a 3-year average simple free cash flow margin, which it gets from up here, and also takes it from here. Then what I tend to do, especially since they're saying there's margin pressures, is I've used only 70% of that margin for looking forwards. So that is saying that on 11.5 billion and a 4.06% margin, they're going to make around about 467-ish million in simple free cash flow going forward. Like I said, I try to be conservative as possible. That puts it at a 8.25 multiple at current price. Well, the industry average, if we have a look, so this is on enterprise value, to get this up there next to each other, the industry average right, here we go. The industry average for enterprise value is probably around about 13. Simple free cash flow 12.3 for Publicis. They're currently at WPP is currently at 14, 15 for IPG, and 10 for OMC. Well, ChatGPT's told me the industry average is 13. So that technically looks cheap, doesn't it, when you look at it like that? Now, problem with that. So say it was 0.43 times 13. Graphic calculator out here. That's returning £5.59 a share, which makes it look really cheap, doesn't it? But you can't afford them the full 13 multiple. To me, that would just seem silly because their debt is a problem. We talked about that previously. The state of the business is a problem. The fact that they're changing CEO, there's uncertainty there. You can't afford them the full 13, not currently, not the way things are. They'd need to prove themselves to get the full 13. So, I mean, I've heard Joel Greenblatt say that when it comes to stuff like this with big debt, that he wouldn't go above 7 for a multiple. Obviously that depends on the investment in industries and all that, but you know, I don't think you can give it a full 13, not currently. The only other thing is that they stated that with the debt that they said that they're going to pay off, obviously that's going to affect the leverage in the company. So if you had if you've got the current enterprise value of 9.166 billion, if you take away the total debt from that, which is, here we go here, 6.754. Now we've stated previously that, you know, it seems unlikely they're going to be able to pay off the full 2 billion that's coming due, but they could certainly pay off, you know, 1 billion quite comfortably. So if you took away 5.754 billion in total debt, and then you added back in the cash, so what we're trying to do here is take it from enterprise value to equity value. You added the cash back in of 1.437 billion, which is actually quite a conservative number when you look at them historically. The average historically over the last, what are we talking there, 10 years is 1.8 billion. So they're actually holding less than what they would average over the last 10 years. So if you, like I said, 9.166 billion enterprise value minus a total debt of 5.754 billion, because we're going to say that they're going to take away, they're going to at least be able to pay off at least 1 billion of that debt, may have to refinance some others, and then you add back in the 1.43 cash, you're actually left with an equity value of 4,849,000,000. If you then divided that by the share count of, there you go, 1,077,000,000, that comes out at around $4, £4, sorry, £4, or it's a British company, £4.50 a share. So in that sense, it looks cheap, taking into account the leverage side of things. But that's something that's going to take place over 3 years. They've got to pay that off in 3 years' time. So when you look at WPP's current share price and then take it up to £4.50 over the next 3 years, you're looking at a 30% increase. Now, yeah, if it happens, that's 10, you know, like about 9% a year annually, annualized. There's better investments out there, I think. I mean, it looks like it should be a good investment, doesn't it? Technically, it's hit this previously several times, right away back to 1998. Every time it has been a huge increase in price. What are we looking up to there? So technically, it looks like it should be something good from this level. For me, financially at the moment, there's a lot of uncertainty. There's a lot of uncertainty with the debt. There's a lot of uncertainty with the CEO. We've covered all that already. I just think that there's better investments out there. So for me, this is a pass. And now I know I've done a 40-minute video on this to tell you that it's a pass. But it is what it is at the end of the day. Sometimes you end up wasting time. My goal here is to try and show everything that I can with regards to my investment style and my learning experience. That's the whole point of this, wasn't it, this channel, to show my learning journey, see whether or not I can become a successful investor. That is my analysis on WPP. So thank you very much for watching. Was there anything else on the tracker that I wanted to mention? Yeah. Not really. The thing here is the lack of institutional ownership and insider ownership is currently quite telling. That's the way that I look at this. There are moves to turn WPP around, as the peers are doing reasonably well, but WPP seems way off and certainly not cheap compared to those peers. The only solace is that WPP is traded significantly higher in the past, which is obviously what I just showed you. Betting on a turnaround, you know, there's a lot of pressure at the moment, a lot of pressure. And I said this bit here, the lack of institutional ownership and insider ownership is currently quite telling. If they were buying, insiders were buying hand over fist, or other institutional investors were going ham into this, then, you know, it would look quite good, but they're not. And at the moment, that's, you know, more evidence for me that it's probably not that great an investment right now. It could be wrong. We'll find out if I'm wrong, you know, time will tell. There you go, my analysis on WPP. Thank you very much for watching, and I will see you on the next one.